This is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for August 24th, 2020. Please see our disclaimer for important information. So in this week's Market Minutes, we get to talk about an S&P 500 stock index, which has flirted with new all-time highs. We set a new record on Wednesday and once again on Friday at the close of the market. And there's a lot of moving parts within that. And obviously not all indices are created equal, so we'll kind of cover that. And we are seeing a recovery in some of the other indices that are still negative and so on and so forth. And large cap and small cap still seem to be diverging a little bit as well. So let's kind of dig into it, shall we? So last week, the Dow was pretty much flat. The S&P 500 was up about 0.7%, and NASDAQ was up 2.7% for the week. And interestingly enough, Apple was a big part of the S&P's gain last week, even though it was relatively muted. Apple was up over 8%, which was almost 2/3 of the S&P's gain. In fact, without that, you could argue that the indices would have been down for the week. But in any case, we've talked often about market breadth, and that there's been somewhat narrowing leadership amongst the technology and healthcare names. And in fact, on Friday, when we set that record at the close, only 220 stocks out of the 500 more or less finished higher. And so, we've had fairly weak overall breadth, and for some time now, as I mentioned. But interestingly enough, according to Barron's over the weekend, that more often than not seems to be followed by stronger returns. So that's kind of an interesting takeaway from that. But we're up 5.2% for the year on the S&P 500, which is 52% above the March low. But the market, again, we're going to have to spend some time talking about valuations because it tends not to be necessarily a harbinger of near-term activity, but in terms of longer-term expected returns, it does have a bearing. So right now we're trading at 26 times the 2020 earnings level. And again, we just came off of a second quarter earnings season in which there was an over 80% beat rate, meaning that 80% of the earnings reports were better than expectations, and those expectations were managed down pretty hard. And I've got a feeling that third quarter expectations are fairly muted as well. So, but nevertheless, the market trades 26 times current year earnings, 21 times next year, and then 18 times 2022, which I think we would all be hard pressed to put much faith into right now. But having said that, I mean, it is trading at a premium right now. We have to be careful about some of the risk factors, which we'll talk about a little bit later. But Dow Jones for the year is still down about 2%, but those losses are narrowing. NASDAQ is up 26%, so stellar performance amongst the tech names. And the Russell 2000 for the year is still down about 7%. And so that's that divergence between what's going on at the large cap level and what's going on at the small cap level. Barclays Aggregate, which is our bond index, is up about 7% for the year. So, interesting that we're still seeing outperformance by the longer term bond indices than we are in stocks. And then the high yield index is slightly positive. Leverage loans are down about 1.7 for the year. For the quarter to date, all of the major indices are up, so seeing fairly good representation. Even the Russell 2000, the small cap, which is still down, as I mentioned, for the year, is up almost 7.7 for the quarter, slightly below the S&P at 9.6 and the Dow Jones at 8.2. For commodities, we still have some relative quarter-to-date strength in crude, and we're getting a little bit better data, even though supplies and demand are still below year-ago levels. But crude is up about 8 just slightly under 8% for the quarter, although down 31% for the year. The dollars, we continue to talk about the dollar and monitor that. It's down about 3.3% for the year and about 4.3% for the quarter. And just kind of a takeaway that the dollar's up over 30% from 2011. So we've seen a tremendous long-term uptick in the dollar. And so I think there's a lot of people that are getting unnerved over the fact that we've seen a 4% shift in the dollar quarter to date. And there are reasons for that. One of which is the 10-year Treasury, which is down about 1.3% percentage points for the year at 63 basis points, which is still helping to make 30-year fixed mortgage rates very, very, very attractive. So, and really, and despite, I guess some uncertainties that we saw within the most recent earnings season, interestingly enough, the S&P 500 has not experienced a daily loss of more than 1.2%, a daily loss of 1.2% since late June. So we've seen a little bit of flagging in the volatility indices. And then, as I mentioned, 10-year Treasuries kind of returning to its kind of midpoint of its range, around kind of that 55 to close to 70 basis points. We do have a lot of Fed speakers and Fed types that are going to be meeting in Jackson Hole for their annual conference next week, and so we would expect some rhetoric coming out of that to potentially influence things. Crude prices are around $40, declining stockpiles, as I mentioned. Interestingly enough, and we had a little chart in the charts of the week about gasoline consumption has kind of stalled out around roughly about 85 to 90% of normal levels. So we'll have to monitor that. Housing data. This is the real shining star of the data points that we're seeing right now. We have record low mortgage rates driven by the low treasury rates and low interest rates overall. Existing home sales nationally hit an all-time record of about 5.9 million in July, and that's up almost 25% from the prior month. Housing starts were up about 23% to 1.5 million, which is close to the cycle peak. Now, a lot of the overall housing gains were from the multifamily side, where projects were more than doubled in the month of July. But for every put, there's a take, and vice versa. And so, with all that housing data, we did see an uptick in unemployment or initial jobless claims that rose back over 1 million to 1.1 million in the last week. But the silver lining there is that continuing claims continue to fall, and they were down below 15 million. And so, again, while we're struggling to find that path for employment, it does look like, at least from a continuing claim standpoint, that the data is certainly improving there. So obviously some things to keep track of. Interestingly enough, in the news flow, over the weekend, we've got basically more election things to talk about. That rhetoric is heating up. That could fuel clearly some volatility coming up. In Bank of America monthly survey of global fund managers found that just 17% of those fund managers expect a V-shaped recovery, while 37% expect a double-dip recession, which is kind of what they refer to as that W-shape, and that's up from 30% last month. So, and I don't think anybody is pricing in a potential for a recession in any of our markets. I think the Fed is going to be working really hard to try to prevent that, but their bullets are maybe a little bit more limited in helping to do that without having a fiscal stimulus in addition to. But as I mentioned, the jobless claims were back over 1 million, despite the fact that we don't have any more $600 per week unemployment supplemental benefits. Interestingly enough, Census Bureau, 12.1% of adults lived in households that didn't have enough to eat at some point during the previous week. And we're just seeing a lot of pressure in a lot of areas from the pandemic, which doesn't really seem to get a a ton of a ton of press here. But and then just looking at back to school. This is kind of what a lot of families with kids are dealing with right now. Interestingly enough, and we had a chart in the charts of the week that kind of talked about the issues related to people being out of work because of COVID-19 related child care issues. Just a piece that came out of the Sandy Leeds package. The cost of child care and nursery school has risen at roughly twice the pace of inflation since 2000. And due to the pandemic, parents are definitely in the market for child care. And the risk that we talked about the risk of the pandemic to small businesses, but in particular these daycares are really in the crosshairs right now. That remote work has been, while it's been a really good thing for corporations, and but remote learning has been really troublesome for many parents and children, and that because of the pandemic, the 40% of child care providers said that they expected to close permanently if they don't get additional public assistance, which I thought was interesting. But kind of moreover to the whole issue of back to school, the impact on retail could be actually fairly profound. And I think people tend to kind of gloss over the impact of what back to school does for retail. But, obviously there's a dislocation factor, which we talked about, the, schools essentially providing childcare for working parents. But it drives a lot of spending at retail. That the absence of a lot of these things could cost the economy $700 billion in lost revenue and productivity at a rate of 56 billion per month. And if you think about lost productivity and basically not being able to be at work for for various reasons. I mean, we're talking about 2.5% of impact to GDP, and then specifically the back to school spending, not just the impact of being absent from work, from having to take care of kids and educate them at home and things like that, but back to school sales represent 15% of annual sales for a lot of department and specialty stores. And 2019 back to school spending was $26 billion. And, according to an article in Barron's, that 52% of parents aren't making back to school purchases, and almost a quarter of those will buy less than normal. And so retailers in general are really preparing for the sales to be down by 1/5 this season. So that's a very interesting development, and I think we'll begin to see a lot of this kind of manifest in the reports that we'll get for third quarter earnings here in just a few months. But we've had some Fed speakers. Like I said, we're going to have the Jackson Hole conference, so I assume we're going to have a lot of opinions coming out of the Fed regarding the need for more fiscal stimulus. Again, just to separate those, the Fed is in control over monetary stimulus. That's manipulating interest rates and things like that. Fiscal stimulus comes from Congress, and so the Fed clearly wants more action from Congress on that regard. So they're thinking about perhaps changing their guidance and maybe changing their approach to reaching inflation targets and things like that. But basically with what we don't know, and this is a risk, and we'll kind of cap this with all of the observations for the week. But the risk is that we have gridlock in Congress. We don't get an agreement on supplemental stimulus. But what the Fed has done to date is basically manipulated interest rates down to zero, and they're going to hold them there for a long time. And so what this has done, obviously it's impacted asset inflation. So home prices are at record highs, stock prices are at record highs. We know that corporate credit spreads have tightened because of the confidence level and the Fed being a backstop to any any widespread credit erosion. And we've got banks in the banking system that are awash with cheap deposits, low cost funding. And the other thing that the Fed has done with their monetary policy is created a huge negative real yield. So real yields are at record lows right now. And so there's really not much they can do. They could create nominal rates that are negative. They could put yield caps, since we've had a little bit of inflation pressure here as of late, or inflation's beginning to creep back in. But, whether it's negative interest rates, yield caps, expanding asset purchases, these are things that the Fed could do, but not sure that they would create a lot of headroom for the economy. It really has to fall back on the fiscal side. So they still have the Main Street lending facility, which is has a large capacity, but really only 500 million has been doled out to date. So they can help smaller businesses with the Main Street lending facility, and the Fed could continue to work towards depreciating the dollar by buying some foreign currency. This would help our exporters and help our domestic producers, and it would certainly help emerging markets too. But really the Fed's bullets are somewhat limited, and I think that the pressure is really going to mount on Congress to do something on the fiscal side. So long and short of it, the observation that we kind of take away is that I think, as I mentioned before, with multiple valuations being fairly high, that valuations I think today might portend lower long-term expected returns. And I think that's going to have an impact on financial planning as people try to meet their long-term portfolio goals. I think clearly, the jobs data, we did not expect a little bit of a retrenching there. So the unemployment data was a little bit up, but the put and take there, as I mentioned, was that continuing claims continue to drop. So we'll just have to look at that, hope that the job market can kind of continue to recover in total here over the coming months. But having said that, I think it's clear that we're not going to have that V-shaped recovery. That at best it's going to look like that U, and it's going to take us a while to kind of get back to where we were. And I think the recovery is going to be mixed, and it's still going to be relatively uneven. We've got the school issue and the productivity issues that have been born from that. We've got the risk of the new virus, and obviously the worries over the fate of the new stimulus package there as well. But housing is good. We certainly want to see continuation of the strong housing start number that we had in July, which is at the strongest level since 2016, so we certainly want to hope for continued good data coming out of housing. The likelihood of some new stimulus package, the market has really already priced that in, and so we're going to have to be real careful about any shortfalls, in unfulfilled expectations, I guess I should say. And when Congress convenes, will they be productive in achieving some kind of resolution to get that stimulus package approved? I mentioned stock valuations. We certainly have ample liquidity, and we have well-supported monetary policy, but I think we could still be due for a little bit of pullback, and certainly heading into the election, a little bit more volatility. I think, as we get a little bit closer, depending on, this whole D versus R rhetoric, if it does appear at some point that perhaps Biden is going to get elected, then, obviously people are going to wrestle with the possibility of higher tax rates on the wealthy, and higher corporate tax rates, and perhaps higher taxes on capital gains as well. But I think just, long and short, we have this market now that it's at all-time highs. It kind of feels weird because we're in the middle of a pandemic, and we've got so many people that are struggling out in the market. We still have the risk of the virus resurgence. We have possible, U.S. federal debt downgrade. We have still a lot of uncertainty at the state and local government fiscal level. Their fiscal condition is still uncertain. We have the risk of non-performing corporate loans rising, risk of commercial real estate prices, as we kind of evolve into this era of uncertainty with regard to what is the office market going to look like post COVID-19. Clearly, we still have the U.S.-China relationship has become quite hostile, and we've got other geopolitical issues, some emerging markets which are coming under pressure, and the risk of perhaps some longer-term inflation. But clearly, until we get a vaccine of some sort, you're going to have all of these things kind of weigh on the conscience and weigh on the confidence, frankly, that's, as I said, is priced into the market. So this is just another week in our journey, and I obviously will continue to monitor the data. I think, from a longer term perspective, things like this will work themselves out. Question is what kind of a long-term expected return that we should expect for the various asset classes. And I think, it's best to kind of draw upon history for the time being, but we want to refine those numbers over time, because I do think that we'll need to be a bit more circumspect as we go forward. So that will do it for our Market Minute segment this week. Hope you've enjoyed it. Please feel free to reach out to us at the information on your screen. We'd love to hear from you, ideas, questions, comments, cares, or concerns. So until next week, be safe and have a wonderful week.